All right, welcome everyone. I'm Spencer Davidson, Senior Vice President with Hunter Advisors, formerly Hunter Hotel Advisors. Welcome. Really appreciate all of you guys being here today and for my panelists for being up here with me. Before we get into our topic, which is deals, transactions, reimagined, just want to show of hands how many people in the audience either are wearing or have a Whoop, an Apple Watch, or an Aura right now. 1, 2, 3, 4, 5, 6, and probably a whole lot more. I'll raise my hand. I'm wearing a Whoop band. We are all, I think, at the ethos obsessed with tracking our health, our heart rate, everything that can transpire, and we're just out of focus, whether it's ourselves or industry. My panelists up here have the best pulse on the industry, I think, available, and I'm super happy to have them available for this chat. So I think we're going to take a really deep dive into everything from the brokerage side, investors, lenders, to really unpack how deals are getting done today. I think the headline might make you think that transactions have been on a pause, but I can assure you they are not. You just have to unpack where the opportunities are, how they're getting done, how they're getting financed, and who are our buyers and sellers. It's a cyclical business, and if you can't handle the heat, stay out of the kitchen. But you guys all can, which is why you're in the room today, so thank you. I'm going to let my panelists do a quick kind of introduction and maybe talk about their firm for a second, and we'll hop into it. Jared?
So I'm Jared Schlosser. I'm with Peachtree Group. I run our global lending originations. Did about $3.1 billion last year. That's up from 1.6 the year before, 1.2 the year prior to that. So a lot of volume, a lot of growth over the last few years.
Great. Amit?
My name is Amit Patel, CEO, co-founder of Spark JHC. We're a $650 million AUM private investment group focused on select service hotels across the country.
Ruby?
My name is Ruby Huang. I'm Senior Vice President of Portfolio Management with Brookfield. We're headquartered in New York. We're a global asset manager, and we have $1 trillion of assets under management. We invest in infrastructure, renewables, credit, wealth solutions, of course, real estate.
Ben, last but not least.
Hi, I'm Ben Brunt. Lead the investment team at Noble Investment Group. Today, we are a $5 billion AUM investment manager. I have a focus in upscale, select service, and extended stay. That's really our core business. And our core platform, we also have a branded long-term accommodations platform where we are acquiring and building to scale extended stay assets in the mid-scale and economy segment.
Perfect. And I think, Ben, maybe I'll start with you. How active would you say Noble's been over the past kind of 24 months?
We've been fortunate. We've had, a lot of transactions. Nothing, is easy. Everything takes a bit longer, today than I would say in times past. But we've been super active. We've put out around $400 million in equity, last year. So a significant amount of our current fund, Fund 5, was just over $1 billion in equity commitments. So we are close to fully investing that vehicle and in the market for our Fund 6.
So I guess on the heels of that, post-pandemic, I think every major private equity shop very quickly pivoted into private credit. Jared could probably touch on that, but I think we can safely say that private equity is back today. Would you confirm that, Ben?
The way that Noble really positions itself in the market is a specialist investor in hospitality, and we've selected segments that we stick to. So we've never been out of the market, and we, because we're not an allocator, we didn't shift gears and say, okay, well, hotels are not interesting right now, let's go do data centers. So we're always in the market, and I think that, gives us, somewhat of an opportunity edge when other allocators perhaps leave the market for a period of time.
Great. Earlier today on the first panel, I heard Bob Webster say that this is the second best buying opportunity he's seen in his 40-plus year career. So despite any pause that might be from a headline perspective, I think there's significant opportunity both on the buy and sell side. Now, Ruby, I think we touched on earlier, but Brookfield has over $1 trillion in AUM. How do you guys think about managing capital within the hospitality space today?
Well, first, let me address that in 2025, we were extremely busy fundraising, and we were very successful. We actually exceeded our target fundraise with our Fund 5, and we closed on our Fund 5 at $17 billion. So we are very active looking for various transactions on the acquisition side. But for me as a portfolio asset manager, one of the things that I focus on is Hospitality Investors Trust, which is a select service portfolio which Brookfield bought in 2017, restructured it post-COVID, and over the last 2 years, we've been very active in the unwinding side of it. And over the last 2 years, we've been very busy in unwinding this portfolio and selling down assets, selling actually in various single transactions, generating gross proceeds of over $660 million.
Amazing. So I think there were 49 hotels sold since 2023, so remaining fairly active. Why do you think it's a good time to buy now?
I think that there is a lot of quality assets, and if you're nimble and patient and you look for it, there are some great assets to find. And when you pair up buyers and sellers in certain markets, I think that there are some great opportunities, especially the capital markets right now. I think Jared can speak to that. There's going to be great opportunities to be able to align all of those stars to be able to put together a perfect transaction.
Of course, you need a good broker to do that, right?
Absolutely.
Perfect. Amit, maybe talk a little bit about Spark and your history, and how you guys have come to a growth trajectory over the past 24 months.
Yeah, I'll actually go back 36 months. We've done really over 20 projects, deployed over $150 million of equity, all friends and family retail, about 551 investing entities that have supported us in our platform. We are very active in the market. Our box is what's unique is we are the $15 to $50 million select service box, secondary, tertiary markets. And it's really, we've expanded that quite a bit now. And so in the last 24 months, we've done $110 million. We have about $100 million here. We're closing here in the first quarter. So very active. Again, looking for that select service extended stay box, high quality assets, of course.
So finding opportunities has been pocketed, would you say?
Yes, 100%. And so we're fortunate to have good relationships with brokers like Spencer here, and then obviously other groups like management companies and Noble and stuff. So we're very fortunate to find good deals in the market. So.
Great. Let me pivot to Jared real quick, because I think everybody can agree that buying hotels is essentially a game of math and leverage, and the math and leverage has changed drastically over the past 36, even 48 months. But I think we're all encouraged that interest rates have come down significantly, over 300 basis points, and debt may be at its cheapest place today than it's been in years. So safe to say you guys are getting a ton done on the credit side. Now, is that refis? Is it acquisition? How do you think about that? What does the deal flow look like for you guys right now?
So we did about $1.6 billion in hotel loans last year. Normally it's split probably in a given year, 60-40 acquisition to refi. Last year it was probably 90% refi. You're starting to see more acquisitions this year in general, so you're seeing more acquisition financing. And the pricing on acquisition financing is probably 50 to 100 basis points tighter, because people want to lend on new business plans and fresh capital. So you're seeing groups get more aggressive on acquisitions, but there's still just a ton of backlogged deals that lenders have kicked the can on, that have to go through the system and have to get refied out, and that's still a big chunk of our pipeline.
Amazing. And I saw a LinkedIn post that you had this week that said, it was a quote from somebody that said, "Hey, my lender blew out. How quickly can you close?" How often are you getting that phone call, and what's kind of driving that? Are lenders pricing too aggressively and not getting to the closing table? You find an opportunity to close within 2 weeks, and you guys can hopefully pivot on a very quick basis. But is that a very frequent model or phone call that you're seeing?
I get a lot of those calls, probably because I say I'll close in a couple weeks, which is ridiculous, but I will.
So call Jared.
I think that, hotels are really hard to lend on. Everybody in this room, everybody that's at this conference, they understand hotels, but when you get into a group with people that don't do hotels every day, they just simply don't understand it. And you have this just massive movement into quote unquote private credit from a lot of groups that raised equity funds and couldn't deploy that capital. So you have a lot of people that are lending on hotels for the first time, or a lot of people that have CLOs that are saying, hey, I can get an extra 100 bips lending on a hotel. And the second that there's a bomb in Iran or oil spikes or, it snows in Atlanta in March, lenders are going to start retrading. And it's just, we see it every year. It happened last year with the tariffs. And oh my God, there's tariffs, and people just drop deals. And we got a lot of those phone calls. And I think, we're going to see a lot of that activity over the next, 2 to 3 months, because there's just a lot of uncertainty out there. And it's hard to lend on anything with uncertainty. It's extremely hard to lend on hotels with uncertainty.
Would you say there's a little more certainty from a path perspective on the next 12 months than there's been in the past 24, right? I think everybody's been underwriting 100 basis points next year. Trump's cutting 3 times. We seem to be in a place of continuity amongst the volatility, if that makes sense. So you guys can hopefully chart a little bit better path. Maybe that results in more refinance opportunities for groups that had thought interest rates were coming down but are not.
It's just noise, right? Like when you're in the hotel business and you're a good operator and you have a sound business plan, you're going to be successful regardless of what's going on economically, particularly over a 3 to 5 year horizon. But noise spooks people, and that's what creates the volatility. Everybody up here has a business plan, and they have a certain sector that they operate in, and they know what they're doing, and that's why they've been successful. And so as a lender, you want to lend to people like this that, they have a long track record of doing what they're supposed to do. And as long as you lend to the right people, you should be in a good place. I just think that the challenge is that people that don't understand that and are chasing yield or just trying to deploy capital just to deploy capital, that's when you get into a bad spot.
Makes sense. Maybe, Ben, in terms of deploying capital, maybe talk through Noble's strategy of deploying capital on a larger scale, where it seems to be that the retail investor has been the primary beneficiary of most of the trades over the past 24 months. That's not a necessarily blanket statement, but we've seen institutions continue to sell off portfolios of older fund assets with pressure from brand CapEx related. How has Noble found the larger opportunities in the market?
Yeah, so again, we stay focused on our segments. And that has it's led to, we know where the portfolios are. We know what markets, we want to be in if it's an individual asset. So, we're pretty strategic in terms of how we map, ourselves across the country, where we want to be. And then again, it's tracking the portfolios and, getting in to ensure that we have those conversations. So we were fortunate in the last, 2 years. We probably, want to say, at least 5, portfolio transactions of significance, where I don't feel like we had, meaningful competition. And, a lot of the allocators that used to pay attention to our space, in the scale that Noble is now acquiring, they can't really spend the time from an allocation standpoint to focus on this segment. They've raised so much capital, like Ruby said, and the individual deals, even if it puts out $100 million in equity, often is too small, for some of the larger allocators. So we've come into what I view as kind of a sweet spot, for our segments, and when we have scale and the ability to to raise the equity and have the right lender relationships that allow us to move with certainty and speed, we found a lot of opportunity.
Yeah, so it sounds like you're finding a lot of equilibrium in the market. And I guess, Ruby, just to kind of come back to the 49 hotels that you sold, I think blanket question that a lot of the buyers are going to want to know is, are sellers willing to negotiate a little bit more today? Have you found, that as have proliferated significant transactions in the market?
Yeah, absolutely. Everybody wants to negotiate, and I think that's the smart thing to do. But I think that, we're winning on both sides. We are motivated to sell because we have a horizon in terms of our fund life. We need to recycle capital. We're an institutional owner, and we've owned them long enough. But then on the flip side, we have advisors like Hunter who are pairing us up with buyers who are great and can offer economies of scale in their localized markets, who can bring in even incremental efficiencies in operating by perhaps converting the third parties into in-house operating the hotels themselves. They can also perhaps execute these PIPs in-house and be able to do them more efficiently than maybe an institutional owner can do it for. And last, maybe they can find debt that is even more favorable. And so all of these things align, they can put together a deal, and then with additional negotiation, it's a favorable deal. So overall, I think with everything, we've been able to acquire these transactions and be in a favorable place with those individual transactions that we've executed on over the last 2 years. We've been happy with the results, and we've been delivering great results for our investors. Sub-8 cap rates before CapEx. We're happy with that. We're very proud of those results.
Great. And, Ahmed, I think maybe that falls into you guys as a receiver for some of these assets. And you talked about a little bit about the success that you've had, but, on a forward-looking trajectory, Lark, I think, projects about 0.6% RevPAR growth this year, and that's with World Cup. So you may be at flat to slightly negative, but you guys continue to find opportunities. Where are you finding the best opportunities in the market, whether that's for you guys on a localized basis or as you search on more of a national scale?
I think there's a few different ways that how we're finding deals today. It's been relationships. So, it's the third-party management companies that we've continued to partner with. It's groups with brokerage companies like you guys, like Hunter, and it's also having strong relationship with a lot of institutional groups out there, like Brookfield and Noble, and being able to transact with them enables us to really get deals that make sense for us and getting to pricing guidance to where they need to hit. And so we're able to find really good deals, high quality assets that require soft goods PIPs, good in-place debt yields that we're able to get good debt terms on and transact pretty quick. And so again, we're fortunate that secondary tertiary markets is where our primary focus has been, and we've been very successful at it. So.
Perfect. Have you used Stonehill for anything on the financing side? Meet Jared, primary beneficiary number one. Jared, I think this opens up a really interesting opportunity from the math and leverage perspective of what type of deals are really most financeable today for you.
I mean, for me and for what's most financeable are probably two different things. But I think in terms of what's most financeable, it's cash is king. If you're looking at a loan that has a high debt yield or double-digit debt yield, there's probably tons of lenders that can make that loan. As you fall below, an 8 or 7.5 debt yield, there's maybe a handful of lenders that know how to operate there. And so we'll do both, but where we've kind of focused our investment thesis is on the deals that have a struggling cash flow situation for some reason, but it's either a really strong sponsor or it's a really strong basis that we can get comfortable if we ended up having to operate it someday.
And outside of a potential 2-week close, which hopefully you guys can get done if you need to, how has the pressure been from outside financial sources? Have you seen bank debt and other sources of capital come back into the market?
I think banks have come back more in 26 than they were in 25 to start the year. It's definitely a competitive environment. I think that, again, there's a lot of other debt funds that have entered the space or are struggling to put out capital in other asset classes. So they've kind of entered into the hospitality space. But at the same time, we know what we do and we know what we do well, and it's usually those transactions that have a complicated business plan or don't have the cash flow where anybody could figure it out, and that's really where we lean into.
So Ben, in terms of making the math, as you say, where are you guys finding the most opportunity, or where are you the most opportunistic going into the next 12 months?
I think we've shifted somewhat, away from, heavy physical value add, opportunities in this environment. What I'd rather do is focus on, finding opportunities that have meaningful operating leverage. And what I mean by that is, where in the P&L can we find opportunity? And, that's been a key to our success is, finding opportunities to kind of rebuild the revenue stream, and then also take a different approach to the operation of the property. The way that we kind of think about it is, buying in that, 7.5 to 8 cap on in place, but that in place may not be my in place. And then we're able to take that and turn it to a 10, hold it for cash flow for a period of time. At that point, we're in, a debt yield territory where we're 12 or north of 13. And so back to what, Jared was saying, we're, financing at that point 65%, anywhere from today 175 over SOFR to, low twos, depending on, the lender.
Yeah.
So we've really seen, spreads come in over the last 6 months. And so that math for us works. It's an 8, take it to a 10, and then sell it at an 8.
And
that gets
traditional
us
hold
to,
period depends.
Traditional hold period is 5 years. Yeah. And we've been successful over the last. Some of the stuff that we acquired in 21, we've already exited. So there's been some good opportunity, to get higher yields, as a result of that model.
Yeah. And Ahmed, sounds like you guys are prepared to capitalize on that as well. But as you continue to deploy capital, maybe on a smaller scale than some of the larger institutions, how are you guys thinking about your exit?
Yeah, typically, all of our deals has been historically we've been in 3 to 4 years, heavy value add post-COVID, and now our strategy has completely changed to go more towards a 5-year term, and then look for again light hand holding in place, good strong debt yields, cash flowing assets is kind of our strategy going forward.
In terms of capitalizing on quote unquote distress, how do you guys think about that? Are you looking at multiples basis from a buying opportunity? If you're buying at sub 6% cap rates, which can happen, right? There's dislocation in the market. There's basis plays that are attractive. Is that capitalization a major turnaround story from pure value add? Are you able to achieve much more accretive financing on those opportunities, or as you aggregate that, there's a go forward path there?
Yeah, I mean for us, it's again in place debt yields that are hitting at least 10 plus on our deals, and we're getting good debt terms on it. Again, low 200s on non-recourse deals, and that's kind of been the strategy going forward for us, and being programmatic with our lender, right? That relationship is critical, and so we're able to allocate. If there's an allocate of like 100 million, 200 million, those are the kind of relationships that we built, and so we're aggressive in the market to go after.
Yep. And from our seat, I think Hunter Hotels sold about 114 assets last year. So the transaction volumes continue to persist, and we've seen pocketed opportunities all across the domestic U.S. But Jared, as we talk about catalysts for selling, whether it's debt maturity, how much pressure to sell is there today from the cap stack perspective on the quote unquote wall of maturities that has evidently been coming for the past 5 years?
I mean, I think there's pressure from maturities. There's also pressure from a capital raising perspective. I think more so than the maturities, right? There's a lot of people that, they're struggling to raise capital right now because their deals from years ago haven't returned that capital. And so you've got to sell to get free people up so they can invest in your new stuff. And I think that I'm seeing, frankly, more of that than I am kind of maturity driven. I do think that lenders and banks are tired of kicking the can. So I think as you get through this year, you're going to see a lot more of those debt maturity transactions. But I think the capital raise side of it is probably putting as much pressure on people needing to sell as the actual underlying maturities.
And I think it also it takes a while for things to cycle through. When we look back at our track record, some of the best deals that we did were 2013, 2014, 2015. And that's, five, 6, 7 years, after Lehman. So, we're kind of hitting that, point after COVID. Not that it's absolutely, the same path, as the GFC, but it still takes a while for a lot of deals to cycle through. And to Jared's point around kicking the can, it's tired partnerships, worn out, deals. People just want to be done. So we are seeing a lot of that drive opportunity.
Yep. And I think, whether it's Noble or any other kind of institutional firms, we've been hearing, billion-dollar fund, billion-dollar fund, billion-dollar fund. And I think what that's signaled to some of the market is everybody's got a ton of this capital to deploy. I think what I'm hearing from you and pretty much everybody on this panel, rightly so, is patient capital pays off. Some of the portfolio transactions that you guys have looked at probably have been across your desk a couple times and take years to come to fruition. Is that correct?
Absolutely.
Yeah. And Ruby, from again, $1 trillion AUM type company, how does that patient capital come into any sort of hold sell analysis that you guys go through before you deploy on something like HIT, which you've owned since 2017?
We are patient, and we do have, hold horizons, but we're not going to sell because we have to, because we can go back to unpack and we can ask for more time, because sometimes you just need to. So, with HIT, we've owned it since 2017, and, it was not the right time, and so we've changed strategies. At one point, we considered portfolio sale. That was not the best strategy, so then we pivoted, and now we're selling in single transactions. And now that's how we've been able to optimize our returns. So I think ultimately the best way, and even with a big company like Brookfield, we are able to evolve our investment strategies and be able to hold on for certain assets longer than we have to in order to maximize returns for our investors.
Perfect. Jared, just want to come back to you real quick on the lending side. We talked about a 10 cash on cash or 12 DSCRs, which everybody would ultimately like to see. But with the volume that you guys are doing, what percentage of deals comes through that is either not financeable or not at those levels, but have some sort of value add or creativity story to it, whether to your point is fresh capital that you guys can get comfortable underwriting?
I think you have to think outside the box in this market, more so, I think, on the development side than on the acquisition side. Every development deal you see now has some sort of tax abatement incentive. It's got either CPACE or some form of financing that you don't see every day, just because the costs have been significantly increased, and hard costs, labor, everything, and plus you're now in a situation where outside of like true limited select or extended stay, you're building hotels that are at a per key number in a lot of markets where nothing is traded in the last few years even close to that.
Right.
So I think that's where you're seeing a lot of the real creativity. In terms of on the acquisition side, I think to what these guys are saying, if you've got a double-digit cash flow, you don't need creativity. And if you don't have a double-digit cash flow, there's debt out there. You just have to be willing to pay more for it, because it's going to be to a private lender, and you're probably going to have to create new relationships that aren't just your local bank in order to finance that asset.
And what are you telling your clients? For the past couple Fed meetings, I think quarter basis point has been music to everybody's ears. The reality situation that probably everybody in this room knows is you shouldn't be doing a deal over 25 basis points. So how much, and this may be a question for all of you guys, how much real cushion do you feel like you need to make that deal pencil, whether it's on the lending side or the buying side?
You said it. If 50 basis points is in between you buying something and not, don't buy it. I don't like it. It's not going to work, because the news changes every single day. If you looked at the forward curve, which we make floating rate loans, forward curve hasn't been right in 10 years, but it just goes like this when you pull it into your models or whatever, it's like
Forward roller coaster.
yeah, I can't figure out where rates are going, and if I did, I probably wouldn't be here. I'd be doing something else. So
If you find that crystal ball, let us all know.
that's right. So it's just, if 25 or 50 basis points is in between your deal penciling or not, then it's probably not something you should do. And if you're buying something at the appropriate cash flow level where you go get a bank loan, it's not going to make the difference where that's going to make it pencil or not pencil.
I mean, I think the biggest indicator for us is how accurate is that change of ownership PIP, right? Where's the cost coming in for that PIP? And so, I may think it's 20 a key. Sorry, he may think it's 25 a key, and
The broker's usually right.
the broker's always right. And so that really determines where your guidance comes in, or how you price the deal, and how lenders look at it. And so we're very much looking at that change of ownership PIP very closely. And then we always look at how our operators, our third-party operators, are underwriting our deals, right? So we can evaluate maybe 3 to 4 operators to underwrite our deals, and evaluate which is the right push and pull to make sense to make the deal work. So,
Ruby, Ben?
I mean, I think the one thing that's helping us right now is that the supply is low, so it's giving us some cushion, to if we get any of these things wrong, we actually have low supply in the pipeline, so we have time to self-correct.
Yeah, I think that's a massive secular tailwind that, will serve us all well that are investing, through this period. But, back to the PIPs, we found that, the brands are still, very much, willing to negotiate. We negotiate every, aspect to the scope, and, really, we want to do the right thing for the guest, and obviously, create a product, that is as good as it can be, within reason for, relative to cost. But that's a huge part, of, kind of the value that I think we bring to each individual asset, is determining that scope and then, figuring out the optimal time in which to, put the CapEx in.
Yep. And from an opportunity perspective, we talk about all of these pressures. Would like to go around real quick. Where does the next wave of deals come from? Is it from sellers or is it from lenders? Jared?
I think it comes from lenders. We've bought probably $800 million in notes in the last 4 months, 5 months. I could easily see us buying as many notes as we originate this year. I think it just comes down to lenders are tired of kicking the can. And if you've got a super cheap rate at a bank and they don't want to refi and they don't want to sell, then what do? Well, you sell their note. And that's where I think a lot of transactions may spur.
And do you think those lenders have been shy to raise their hand and say these notes are for sale, or they're just now coming to realization?
Generally, they're not running a huge marketing process. They know, there are people out there like us and others that play in that space and close quickly and know how to keep things quiet and do right by the borrower eventually. We're not in the loan-to-own space, and I don't think any bank wants to sell the note to a predatory lender. I think that's what you're starting to see a lot of over the first quarter of this year, end of last year.
Interesting. Amit, as you guys have looked at a variety of deals, both on full serve, limited, and select, what would you say the most mispriced segment is today in your mind?
the most mispriced segment, I would say, is still in the limited service space. I think sellers are still optimistic about where their valuations are coming in because of where their bases have, and then in the deal. And so I think they're just being more aggressive of where they really want to be on the cap rate, and it's not really realistic to where their T12 looks like. So.
Perfect. Well, I want to go around the room before we close and ask for any Q&A if anybody has any questions for our panelists. But just real quick, Ben, I'll start with you and then go around. One sentence, what does it take to get a deal done in 2026?
Conviction.
One word. Wow.
Word.
Conviction. I like it. conviction in the underwriting, conviction in the operations.
Yeah, you need to know the market, know the market cold, have the relationships, from a debt and equity standpoint to, articulate it, sell it, however you approve deals, through your investment, committee process, and then have the courage, to follow through with your business plan relative to creating, the opportunity through operating leverage. I mean, that really is, I think, a differentiator in terms of how, at least in our world, our LPs are viewing a group like Noble. They want to see, quarterly distributions. They want to know that you have that, the systems in place that allow, to have a business that's just not back-end loaded. A lot of the challenges that, and I imagine that this is also, runs true with, club deals or friends and family opportunities, is the distributions are important. So waiting for 5 years to see if it turned out okay, is I think the world the investment world has shifted from a real estate perspective to more of a, distribution-oriented investment. So if you can put the pieces together and it lines up in that fashion, I think that you have a great opportunity to get something done this year.
Yeah. So despite the puzzle piece you have to put together, Noble is opportunistic?
Yeah, very much.
And optimistic. Perfect.
I have to be.
We all have to be. We're all up here for a reason, and we chose this industry out of choice, hopefully. Ruby?
You have to work with the best partners at every stage of the transaction. So obviously start with working with the best advisors to pair up the buyer and the seller. You have to find the best lender to secure your debt, the best project managers to execute your PIPs, and obviously the best operator to execute your business plan.
Well said. Amit?
I think for us, it comes down to the relationships that you have across the process, whether it's from your lenders, your investors, franchisees, folks, everything what it takes to get the deal done. You do what you're going to say you're going to do, and you do it, and you be aggressive about it. And that's the way we think about things. But yield is everything. I think what Ben said was right. And so our investors expect that distribution. And so every deal we evaluate and underwrite, it's driven by that return. So we are optimistic.
Last but not least.
I think it just takes grit. I mean, the real estate business in 2021, 2022, due to just an influx of cheap capital, there were just a lot of people that jumped in the space that just probably should have never jumped in the space. And in 2026, raising money is hard. The market is hard. Underwriting P&Ls is hard. Business plans, increasing cash flow, all of it is difficult. And you either have enough grit to persevere and get deals done, or you don't. And the real estate business is supposed to be hard. And I think it's just gotten back to being hard again.
Agreed. I mean, operating a hotel is no easy feat. And I think what I've gathered from all my panelists up here is that deals are not easier, but they are way more intentional today. And I think the winners in this cycle are not going to be the ones who deploy capital the fastest, but who remain the most disciplined. You guys have shown that. It's proven in all of your business plans and models, whether it's on the buy side or sell side. And there's no better panelists that I'd rather have up here to discuss it. Do we have any questions from the audience? Happy to pass around the mic for Q&A. You got a question over there?
Good evening, or afternoon at this time point. In today's constrained capital environment, what under-recognized signals are you watching that can indicate where the next wave of institutional hospitality investments will emerge?
Anybody want to take that head on?
What are the indicators that we're looking at?
You looking for indicators of?
Indicators, more of indicating the institutional process of the next wave of the hierarchy that we should be looking for the transitional, for portfolio development and so forth.
So kind of what's going to spur any sort of institutional deployment of capital, or how?
Yes.
Okay. the benefit.
Yeah, I mean, I think we're in a disciplined investment environment today. So to Jared's point earlier, when money was cheap, a lot of deals penciled, for anyone. And today it's very difficult, for that to happen. So you need to have a real business plan around markets, segment. I think staying focused and having the relationships that allow you to to do whatever investment is that you're thinking through. But it is I think the discussion that we've had, it's just a different environment. So yield is very important, and unless you have a path that's going to allow you to generate that, both through how you buy it and then what you do to change it physically and then how you operate it, I think it's just a different environment. If you don't have those three things, then it's going to be tough, and you're going to wind up paying a lender way too much, in order to get your deal done, and then you're just going to struggle, throughout the process.
Yeah, in front.
What do you think sort of the role of hospitality will play in terms of acquisitions over the next couple of years, and also for large institutions and privates?
I'm sorry, I missed.
Yeah. Repeat that real quick. Sorry.
What do you think the role of hospitality REITs will be in terms of acquisitions of assets, sellers and investors like yourselves, and then also for large institutions? How do you think the take-private environment will be for hospitality REITs over the next couple of years?
So specifically for REITs, I mean, I don't know if you guys want to touch on the public segment at all, but there hasn't been a ton of activity on the REIT side. I think we've seen a major disparity between stock price and net asset value, which has kind of put everybody in a lock. In terms of activity on that side, I don't know if any of you guys want to take that head on from an investment perspective, but it's public capital. They need to return investment to their shareholders as well, and I think there's probably a catalyst for a major step back into the market in the next, hopefully, 12 to 24 months at minimum. Yeah.
For first-time hotel owners, is there a space for that with everything that's being said, with how hard it is to get lending and all of that? Is there a space for first-time hotel owners?
Amit, Jared, are there?
I mean, I'd bring on a partner.
It takes a lot of expertise, right? So our background's been we've been operators for 30 plus years, from a family business before, and so bringing on a partner like Jared said that has the expertise and trust to really perform is going to take everything for first time owners. So.
And I would say, to add on to that, one thing that I've gathered from working with all of these individuals on stage is to localize the ownership. Make sure you own and operate in a market that you know well and that you trust, especially for a first-time acquisition. Coming from a broker.
Hey, good afternoon. You mentioned C-PACE and SBA and other tax abatements. Any other incentives out there that are coming up real soon?
I mean, there's all sorts of stuff out there. The more that you can, think outside the box and meet different people, particularly at these conferences, everybody's running around trying to do deals, myself included, but sometimes you can strike up conversations with people that are things you've never heard of. Like I was explaining to somebody, we've been lending out of an EB5 rural bucket where, we're effectively able to back lever a loan in a rural market and provide cheaper construction financing than we traditionally do. And that's something that, most people have never heard of, right? And, there's all sorts of people running around here with, different incentives and different ways to look at the world that some I agree with, some I don't agree with, but I just think, the more knowledgeable you are on these ancillary products and lending products, that may be the best way to finance something. Like I'd love to tell you that everybody can go tie up an asset and walk into a bank and get a bank loan, but that just doesn't work. So the more you're able to find creative ways to raise equity or to capitalize your project, the better off you're going to be.
Fine, go ahead.
Hi, everyone. How are you guys thinking about the AI impact in investment committee and for New Deal underwriting?
It's all still, very new, but we're digging in meaningfully. And so the expectation is that it will have, a massive impact in terms of how we think about markets, how quickly we can get up to speed on markets, how our financial modeling, works, could redefine our workflow. So there's still a lot on the table to, understand and begin to implement, but it is a significant topic in our IC.
One more over there.
Hello. So you guys talked about how lenders are tired of kicking the bucket down. How does that affect the financial modeling? And then what are the alternatives that we can expect to see in the near future?
I'm not sure it affects the modeling as much as, a lot of these loans were made in a different environment where, they were just much cheaper rates. And, at the same time, the underlying economics and operations of the hotel likely hasn't improved, just given the economic headwinds. So the best advice on that it's not a financial model. It's your relationship with I think Ruby said this best, like your relationship with your counterparties is the most important thing that you can do. I can't tell you, like, we joke about 2-week close, but we don't just close 2 weeks for anyone. Close 2 weeks because I've known Ben for X amount of years, or we've been lending to so-and-so. So I think what happens in these situations is a borrower will stop communicating on a regular basis with their lender. The lender gets spooked because they're not getting real-time information, and they've probably already provided 1 or 2 extensions, and they just say enough is enough and they sell your loan. Whereas, if you're communicating with your lender on a regular basis and you're providing really good detail as to how the property's doing and how the company's doing and so on and so forth, they're probably apt to working with you regardless of what's on a model.
But there are also a lot of markets and assets that just have to be reset.
Yep.
And that kind of to what Jared was saying earlier, hadn't happened in many cases. An example I use often, because I'm local to Atlanta, is the Buckhead submarket, which sold 1.8 million room nights in 18, 1.9 in 19 because of the Super Bowl, 1.8 million in 24, and 1.8 million in 25. But we added 400,000 available rooms to the market with 7 new hotel additions. And so that market is now what used to be a 74% market. Some assets actually ran 80. It's now a 62% market. And the reset, for a lot of those values, it's happened for a few assets, but it hasn't happened for others. But it needs to happen.
And from an underwriting perspective, that's just an equilibrium saying 2019, look in the mirror, was 6-7 years ago at this point. I mean, we just can't underwrite to that effect anymore. So there's a new normalization in the markets. One more.
I want to relate to a question about AI, especially for big asset managers like Brookfield. And I would like to hear from you, Ms. Huang. So there are 2 groups of people saying that we're going to embrace it really quickly, and then other people that say that finance isn't going to be as embracing as people think. Most of the people know that they start as entry-level positions, and they say that the analyst years are the years that people grind the most and learn the most. If we embrace it and those entry-level jobs are gonna nearly disappear, how are you gonna train the workforce? Because you start as analysts or from internships, what's gonna happen next when you don't start anymore as an analyst? Have you thought about this, or have the leadership has those kind of conversations lately?
We definitely embrace AI at Brookfield, but we still do value our analyst and associate programs, and we continue to have internship and analyst associate programs throughout the company because there is a value to train the next level of workforce throughout the company. You know, from an asset management perspective, how we're using AI is very important. We're making our jobs a lot more efficient. I'll give you an example. Before, when I had a portfolio of hotels and I had to figure out how to improve menu pricing, I was giving this example before. It used to take my analysts hours to be able to come back to me and say, hey, to improve food pricing and improve the food costs. I went through and examined all the banquet menus across the comp set, and these are the prices I need to adjust in order to be competitive and in order to hit our target margins. Now with Copilot, it's a lot simpler once you upload these banquet menus. So it allows them to be able to do more analysis to help with investment themes, things that are more important. So there are other analytics that they can be working on. So it's not elimination of that job. But I understand your concern. I don't think that it will eliminate a job completely, but it definitely will eliminate the mundane, hourly, thoughtless type of tasks.
Perfect. I think we're just about out of time, so I want to thank you guys all for being here. Every panelist, again, very much appreciate it. And again, I think the takeaway is deals have changed, transactions have reimagined, but there are opportunities. So go find your next one at this conference. Thank you guys for the time.
Thank you.